with you today. Let's talk about what's going on here. The first thing we're going to talk about is, if there is a godsend, it has been cost of production in the last year or so. I mean, we've had a tough time with prices, but one of the good things that we've had in our business is much more affordable cost of production, much more affordable feed. And we're going to talk about some reasons behind that. Number one is there's a heck of a lot of corn in the world. Record production, record consumption, yet record stocks for the third straight year, forecast by the Foreign Ag Service here. I saw another one this morning just slightly below record stocks, came out of the WASDE last week. So very close to that though. So big numbers of corn. We certainly have attracted competition in the corn business since the mid-2000s with higher prices. The proportion of the world's corn that is grown in the United States has fallen, but that's because the amount grown everywhere else has gone up due to these higher prices. Certainly a lot of corn available out there. When we look at last week's WASDE report, and not a lot of changes. This is the final estimate of the 2016 report from USDA, 174.6 on the yield, 15.148. Both are records. Almost 17 billion bushels available at the beginning of the year when we add in carryover stocks and imports. 5.6 billion bushels for feed. That number we think is probably reasonable, up 9%. I mean, we got a lot more hogs out there. Corn is much more affordable. 5.3 billion, a continuation of the flat pattern for ethanol, and then 2.355 billion bushels carry out down here. A stocks to use ratio of 16 to 1, some of the highest we've had in a long time. The midpoint of USDA's range went up a nickel to $3.40 as we've gone through that. Here's the usages. I mentioned ethanol. The only thing that could really change this would be a significant change to the renewable fuel standard, or if the corn lobby was successful in pushing through a further relaxation or a further mandation of some 10 to 15% inclusion rates. There's hope springs eternal in the corn lobby that the Trump administration is going to force the EPA to use the 15 billion bushel renewable fuel standards that's in the law. The EPA has so far said no. The market won't take 15 billion bushels. It'll take about 13.5 billion bushels, and that's where they've set the renewable fuel standard the last 3 years, right in that range. Does that continue? I think it probably does. I can't imagine a more active EPA under the Trump administration than under the Obama administration. And so if that's the case, we're going to continue to probably grow this amount of grain, corn plus DDGs, that is available to feed. You notice this coming crop year, the second highest amount of total feed ingredients, corn-based feed ingredients available in history. We think that that's going to continue to grow some. Wheat, world record consumption and production, and world record stocks of wheat out there as well. It's going to serve as a damper on any kind of price run-up you're going to see on corn. In most parts of the world, wheat is a feed ingredient, much more so than in the Midwest of the United States. And so this is certainly a counterbalance to corn prices. We have corn futures, nearby corn futures forecast in the 350 to 370 range, kind of bouncing around that for much of the year. We just don't see a lot of upside of this, given the stocks level, given the production levels. Now, one of the things we're going to have to watch this year is what's going to happen to acreage. If you look at corn versus beans, it's been a bad proposition the last couple of years for corn because of the cost of putting in a crop and these relatively low prices. The forecast right now that we've run in our shop has corn much closer to beans in the coming year, but still that's predicated on about a 2 to 3 million acre reduction in corn acres in 2017 for the 17-18 crop year, and some growth in bean acres. And so we think that that's going to happen. We can see a little bit stronger kind of prices, but not much. I mean, we still think the prices are going to be close to cost of production. On the soybean side, same story, third verse, not quite record stocks of soybeans. Now, you've seen meal kind of go out of sight the last couple of weeks, and we think that that's some doubt about what's going on in South America. It's certainly not doubt about what's going on here, because we got lots of beans. I mean, we've had a lot of beans. The real question is, what are our exports going to be? USDA has them up about 6% from a year ago. That number could certainly go up if South America runs into any kind of problems, and if that's the case, that's probably what's going to justify this increase in soybean meal. Now, USDA did not change their forecast of soybean meal. That was last week. We've seen this run up recently. This is remarkable demand even without that. Look at this. The relationship of stocks to use ratio to a year ago, up 100%. The stocks to use ratio itself up more than double, and yet prices are higher than they were a year ago. That only happens when demand is shifting outward dramatically. And so a very hot demand situation continues on the soybean side, and we think in the future some concern about what's coming from the South American crop. Our forecast coming out of the WASDE report, we have meal up around the 350 mark here in the first half of the year, lower than that after the South American crop comes on and we see what USDA. We also have higher acres that are going to put some pressure. So if we see I guess I'll go back to my 330 rule. If corn is anywhere near 330 and bean meal is anywhere near $330 a ton, you probably ought to be buying it. I don't think there's a lot of money going to be left on the market. Now, are we going to get there from where we are now? We'll see. I mean, this is early. We'll see what happens with the planting season. That can put some pressure on both of these. We'll see what happens with the South American crops. But still, those low threes, $3 per bushel, $300 per ton, we just don't think there's a lot of bottom side on that. And if you're close to that, you ought to be buying. World protein production by species. The right-hand number is the bars, and that's total. You can see we backed off just a little bit in 16 worldwide, but it's headed for a new record in 2017 of about 260 million metric tons carcass weight or ready-to-cook weight. Here's the individual species. Again, we backed off a little bit on pork worldwide last year, but we're going to be record large in 17, pushed mainly by the United States. Record large on beef production, record large on chicken production. Turkey, I think it is slightly under a record, but it really doesn't matter. In the total, this is almost all U.S. production. Total U.S. production pushing the 100 billion pound mark in 2017. We think we're going to be right at it. We've got 18, up about 2% from that. You can see records here the last 3 years. And on a per capita basis, another increase for 2017. This increase for 16 and 17 are not nearly as big in either unit or percentage terms as we saw in 15. And 15 had recovery from PEDV and avian influenza, both in that. And so that's the reason for the big run up there. Much more measured increases, but still, we're working ourselves back to the 2006 record of right at 200 pounds. We're going to be at 187 or so in 2017 per person. The question in my mind is, if we're going to put that quantity on the market, what's the price going to be? I mean, that's going to be the issue. People will eat 200 pounds. We've proven that way back here. Now, maybe they won't with a new cultural concern over all kinds of tree-hugging issues. Maybe they won't do that. But they will physically eat that much if it's at the right price. Now, I don't know if we're going to like that result if we try to make them do that. Here's the individual species. Record large for chicken in 16. Again, a little bit more growth in 17. Here's pork back above 50 pounds, where we were for a long time before the ethanol-induced cutbacks of the 2008, 9, 10, 11, and those kind of things. So, and some increase on beef. Beef is increasing. It's not going back to 67 or 8 pounds, though. My guess, our estimate is that beef's going to get just over 60 here, probably in the next 2 years, and that will be the top of the cycle for this time. And again, beef's going to start down and be reduced long term once more, just as it's done all the way back into the 70s. The economy, don't know really how to categorize the economy. There's nothing terribly wrong with the economy. It doesn't look like my friend Bob Dealey with No Spin Forecast in Chicago has a model that says that we're not looking at any kind of recession for at least the next 12 months. He has a forward-looking model that's been pretty accurate on predicting recessions, and so he's not concerned about that. He does think that there's some risk on the exchange rate and interest rate side to the economy, and that largely revolves around whether the Trump administration can get its fiscal stimulus policy pushed through. I think that there's some doubt about that at this point. I don't know if it's going to go or not. The Republicans, of course, have a majority, but many of them don't really think that Trump is a Republican, and so that may not count for much. We'll find out after, I guess, starting on Friday when he becomes president. Real GDP growth has been around 2%, 1.5% annually for the year of 16. We don't have fourth quarter numbers yet. Those will be out in probably the first week of February, but I don't think they're going to be a whole lot better. Everything I've read about the Christmas holiday wasn't gangbusters. It wasn't bad, but still, again, kind of a slogging along economy. Real personal disposable income growth still slowing. It's going to end the year at about 1.8%, significantly slower than last year, but still not a bad number. It's kind of true of all these macro numbers. Not great, but not bad. When we look at what's going on the other half of demand, of course, those general economies affect demand through personal income levels. We also have price issues, and so you got to look at per capita consumption and price. We have seen a reduction in prices. Pork, of course, set records in 14 when PEDV was widespread. It's been going down, and you can see the last 2 months of prices, November, December, saw some pretty significant reductions. They're not anywhere near the kind of reductions we saw at the wholesaler hog level. That's always the case. But real prices in November were down 8% from a year ago. And that's one of the reasons we'll see here in a minute that real per capita expenditures were down. You can see beef coming down as well, and even at a more rapid pace as beef production increases. Here's 3 species real per capita expenditures on pork. On all 3 species total. For the month of November, down 4.4% from a year ago. Year to date, down 3.4%. Again, as I pointed out all year, we're comparing to exceptional numbers last year. I mean, this is kind of, kind of comparing every NBA team to the Warriors record last year, all right? Not many times does somebody win 73 games. Not many times are we ever going to see these kind of numbers for real per capita expenditures, especially kind of that much above the year prior, which really started in late 2014. We've dropped back down. We're still on this uptrend. I'm not terribly concerned about it. What's going to happen is once we get into 2017, about 3 months, we're going to start comparing these numbers to these numbers. And then it's going to start looking pretty good on a year-over-year basis, okay? So we need to remember that these year-over-year comparisons are very dependent on the denominator. In this case, the denominator is very large, and so we have these minus numbers. We've warned about these for all year. If we can stay within 3 or 4% for the year, that's going to be a victory. Look where we are, within 3.4% year to date. Individual species, all of them are kind of climbing back up to this 3 or 4%. Some trailed far more than that at one point during the year. It was not a good month, November, for pork, down 8.5%. The 2 drivers, per capita consumption was up 0.5%. Now you say, well, that's not good. Well, I think that's pretty remarkable that with all the production we had in November, we only had to eat 0.5% more of it here in the United States. Why the reason? Exports. Exports were terrific. Now, up 0.5% on per capita consumption can be okay, but not when it goes with an 8% reduction in real price relative to a year ago. And that's the reason that we see this percentage loss during the year, is prices fell. Is that good? Well, if you got a lot of product to sell, you might have to have discount prices to get it moving. And that's what the point that a lot of producers were saying when hogs were down in very low levels, saying, why aren't retail prices coming down? Well, they did. They didn't come down as much as some of you might have wanted. And I will warn that that's not necessarily a good thing. Because now, if we tighten supplies at some point, we have to push retail prices back up. And it's harder to push retail prices back up than it is anything. So we'll see what happens long term. I don't think it's a problem. It's just that month is not going to look very good. My guess is that December is going to look better relative to a year ago. Exports. We talked about it in a minute there, record large in November. This chart shows November might be just a little lower than, I think that's February of 2014. This is carcass weight basis. On a product weight basis, this was the largest month on record, up 18% from a year ago. Year to date now 3.5% larger than 1 year ago. We've had a forecast of 4% for some time. It's been one of those things in our internal discussions. Well, are we going to get to 4%? And I keep saying, yeah, we're going to catch it. It'll catch up before we get to the end of the year, and it looks like we're going to make it, but it's going to be pretty close. We look at individual countries. Of course, Mexico was the real story in November. And I have a little difficulty explaining that because the peso was close to record weak in November, which would say that that product cost them more. About the best explanation I can have on this is that there is some fear that the peso will weaken even further, and so you buy while the buy-in is good. And there may have been some of that going on in November. A big surge to Mexico now. They were up 23% year on year. They're now up year over year versus 2015. Growth to Japan during the month, not 21% above last year. Again, Japan up about 8% for this year. If we look at Korea, only 1% larger than a year ago, but a significant rebound from the summer months. And other markets had their best market. That's kind of all the ones that aren't listed here. Had their best month ever. Tim?
When they export in November, it's purchased.
That is shipments. This is FAS shipment customs data.
So was that maybe purchased in September or October?
It was probably, well, maybe it could have been purchased probably in October, but this is product going off the ports in November.
It might have been a lower price.
It could have been. It could have been. Yeah, it could have been. If we look at China, of course, China was up only 1.8% from 1 year ago in November. Still up about 75% for the year, but not the kind of surge that some were expecting when we had that growth last spring. And of course, the dollar is something we still watch very closely. Now, interesting thing here, it had traded well above the range, its trading range of the last year and a half. Here in late November, it's backed off from that several points since then. Is this? I think it's the futures market saying, we're not so sure about these stimulus packages and things that might be able to drive the dollar up. Whether we're going to have to increase interest rates or not, we'll see. But still above that trading range. We're still not back in it yet. And until we are, I think technically you have to be concerned about this thing going up to 107 or so. Freezers inventories, a big drawdown in November. This was good news. We don't have the December data yet. We'll have it next week. But we pulled about 88 million pounds of all four species, but 88 million pounds more than is normal out of freezers in November, even though we had record beef production and record pork production and near record chicken production. I mean, a lot of product being produced, and yet we pulled it out of freezers. If we look on the pork side, again, a very large reduction in pork stocks during November. Part of this was exports, no question. Down 7% versus a year ago. Hams, kind of the normal kind of drawdown on hams, not much out of the normal there. Ribs, the first time this year it's been under a year ago, and ribs account for a large portion of cold storage. Frozen bellies were the ones that really had the counter-seasonal move, and we saw them light off the belly market here in November and December. How long that remains, we'll see, but these swings of stocks on bellies have been probably the thing that's triggered markets both up and down more than anything else the last couple of years, and we're seeing it happen again here. Profit outlook is not good, but it's a heck of a lot better than it was just a couple months ago. Our forecast for next year is at 242. In November, it was -8. And so we've seen this rally on the hogs market has really had some positive impacts on the outlook here. I don't think there's any way that these kind of returns are low enough to slow down the expansion that's going on in the countryside. And that's the reason we've got supplies up dramatically in 2017. The processes are already in place on 100 to 200,000 sows, maybe more, that we think are going to come along in the next couple of years. And there's nothing there that says that that's going to slow down. If we look at the Hogs and Pigs report, on its face, it was bearish. When you come out with 4 and 4.5% increases in the stocks of market pigs coming to town, a 4% increase in farrowings, a pig crop that's up almost 5%, It's hard to judge that as anything but bearish. And then when you compare them what the pre-report estimates were, they were way bigger. And what did the market do? It kind of had a tough day on Friday afternoon as it was trading around the release of this report. And then it came back on Monday, and it's really dithered a little bit, but it's gone up generally since then. So what do we know? I mean, that's really the question. But still, this was a bearish report. Now, I think it's going to be an important report, and here's why. Some of you have heard me talk over the last year, and I have been less than complimentary of the job that USDA has been doing counting pigs. And I think the data has been on my side on that, because I think they've just been consistently undercounting the pig crop. And I can show you that right here. There's the chart. This is their originals, and here's their revisions. They averaged 2.4% over that 3-year period, 2.5-year period. Only one quarter did they not go back and revise up at least 1%. Last quarter, March-May, the March-May pig crop, another 2.4% revision. They have consistently undercounted pigs. And so when I look at this report, I go, well, maybe we fixed that. These numbers look much more reasonable relative to what I was expecting. So we'll see longer term whether that's the case. I hope they've kind of recalibrated. I had a conversation with them with one of the head guys there in October, and I told him, when I make a mistake 2% pretty consistently, I usually can figure out how to fix that. It's called add 2%. Okay? I don't believe that was a new concept to them, but it seemed to be kind of a shocker. So, if it hurts when you do that, then stop doing that, okay? The breeding herd up 1.5% relative to a year ago. This puts it back kind of in line with where we thought it was going to be. It's been running very close to year-ago levels all year, and every one of their estimates, we think that was being undercounted. We thought it would be up a little more than 1. It was up 1.5. When we look at their farrowings for breeding animal, one of the problems here is when they've missed the pig report low, they come back and revise it up, and then they always revise farrowings to account for the increase. They never touch the litter size. Okay? And so when you go back and revise farrowings up, and you never change the breeding herd, that causes your litters per breeding animal to start going up. And we think this number is probably too high. This downtrend, we think, was explained by a move from crates to gestation pens on many farms over the last few years. And so, at least during the process of changing, that's not a very fun thing. And it usually has some impact on breeding efficiency. And so this makes sense to us. That number really doesn't. But we do think that we're probably going to bottom this out about 1.97 or 9.8 litters per breeding animal. And if we use another 1.5% growth, that gives us this average breeding herd and 11.958 million litters this year relative to the USDA's 11.963 this year. So basically flat on farrowings. We showed you that one. Here's USDA's pigs per litter. And the question that I've been throwing out there for the last several months is, why did PDDV make a permanent reduction in the ability of the U.S. breeding herd to produce pigs? Okay? Why did we not come back to this trend? If the genetics and management and all those things are in place here, why did we not come back? Now, I know that PEDV's had some lasting impacts in some places, and we fought a new PRRS strain during this time period. So that would be an explanation for part of it. But do you think it really ought to be kind of permanently worse? Those are the same genetics, the same management, the same talented veterinarians, all of them involved. Okay, the same veterinarians. You sit on the front row, you're open for it, boy. Okay? They're all the same ones, and yet PEDV comes along, which didn't affect farrowing rate at all, or very little. It would affect litter size, didn't it? And litter size, and we can't ever produce that much again. I don't understand that. But when I go back and make the revisions and change the litter size instead of the farrowings, look where the numbers fall. They're right back on that same trend. This makes a lot more sense to me, and I've laid it out for USDA. And we'll see what happens. But we're using this And that farrowings number I put out just a minute ago, and a seasonal pattern on that for our forecast, and it comes up with some very large numbers. I'll get to them in a minute. Here's the other factor for supplies the next couple of years. Of course, we ended mandatory country of origin labeling in late 2015. We had seen already some growth in the number of wean pigs coming from Canada. Curiously, we didn't see the same rate of growth this year as we did the year before. We had forecast this to be up about 12% for the year. We ended up about 7 and almost 8. 332,000 more wean pigs and finishing pigs coming to the feeder pigs coming to the United States. A significant reduction in market hogs, mainly because two one-off situations last year drove the numbers up, so 25% lower. That's a number we think is going to start growing in the second half of next year when the Michigan plant opens, and will grow pretty substantially in the late 17 and into 18. Sows and boar is about the same as a year ago. So the things to watch are how many more wean pigs are coming down, how many more market hogs. Now, this is all going to get predicated on growth in Canada, because they've got plants that want more pigs as well, and so they're going to try to keep them north. But with the Canadian dollar less than 70 cents, this is a very expansionary environment for the Canadian industry. And I think we're going to see them grow, put some sows down where they can. They have some severe environmental restrictions in some spots. Our packing capacity increases. Most of you have seen this table at one meeting or another, in one venue or another this year. Of course, the big growth, a couple of plants were scheduled for the fall of 16. The plant in Minnesota has been delayed. The last I heard was March or April now. I think it's been pushed back that far. The Pleasant Hope plant is slaughtering somewhere 700, 800 to 1,000 head per day, so they're ramping up. The other two plants are still on track to come on in July. One of my sources at Clemens says he still thinks they can kill some pigs in June. We'll see. It's a long time till June and July, but it looks like we're on track for those expansions. Here's where we were this year. Actual slaughter well above slaughter capacity in 7 weeks this fall. You can do that for a while, but you eventually pay the price. Last week we had a few stories of some plants that didn't run second shifts or didn't run at all because of some maintenance issues. And I think that all adds up when you're trying to push your plants that hard. But still, you can do it for a while. We're going to get big increases in slaughter capacity in the next 2 years. Gross packer margins were record high this fall. If you take the difference between the cutout value and the hog price, times the weight of the animal plus byproduct values, this is what you get. And you can see here a significant increase in the general level of packer margins over the last 7, 8, 9 years. A lot of volatility, but still an increase in those margins, and that's that's the main driver of expanded capacity. You've got to pay somebody to add it. I discovered after I put these together, we got this. I wish we had 2.8 million slaughter capacity out there, but we don't. This line's in the wrong spot. It should be at 2.594 million. This one should be about 2.43. It's pretty close. But you can see the red line relative to the blue capacity line, we were above capacity 1, 2, 3, 4, 5, 6, 7, basically 8 weeks. And we were very close last week again. And here's our forecast, the blue line for 2017, significantly higher. We're going to pretty well fill the plants this fall. They're not going to be full, and we're going to have some slack, but we think the growth in numbers is going to push that a bit coming this fall. Week before last, and we had a few situations that we dodged some big bullets. I mean, we're rocking along here, and they have a fire at Storm Lake. And it gets, we had a fire in September at the Smithfield plant in Monmouth. We had another fire in the rendering plant at Tyson in Storm Lake in November. 2 weeks ago, we had a major plant that was closed for 2 or 3 days because of an animal welfare issue in their lairage. It's those kind of disruptions that can really get with you. Well, it turns out that the fire at Smithfield didn't harm us too much. They were down, a day or two? 2.5. The Tyson plant kind of didn't even blink. I mean, they just went right on. And this one hit at what could have been a terrible time, but it wasn't too bad. But those are the kinds of disruptions that can really hurt you when you're right against capacity. And I don't think we're going to be that tight again in the fall of 17, but we're not going to have just a lot of slack out there either at the rate we are now. Our 2018 projections, you can see the brown line here, a little bit of growth kind of all year long. We don't have a lot of growth by then because we don't think there's just going to be that much incentive to grow at that point. That's really a swag looking at 18 now, okay? Our company says we're going to put a number out for 2 years. I keep saying, okay, I'll give you a number. I don't know if it'll be any good, but I'll give you a number because there's no data on it. Weights were the real hero this fall. Took about 1.5% off production in the fourth quarter as we stayed extremely current. And that is to the credit of the people shipping the hogs and the people working in the plants. I mean, they put in some yeoman effort to keep these hogs moving, kept weights under control. We're down still about 3 pounds below a year ago on these producer sold barrels and gilts. That's going to track pretty well through the first quarter. We'll probably move above those as we get the market strengthened in the summertime and start adding some weight as we go through the last half of the year. Puts FI pork production record large this fall, well above where we were in 2016. We see some big numbers again in the fall of 18, especially if the Prestige plant does indeed get opened in October of 18. The cutout value, I think it's remarkable that from October to December, the cutout value went up. I mean, I would not have bet on that with anything in October. But some real strength, a little bit of strength in November, and then a real rally in December. And you can see how counter-seasonal that is. This is the average for the last 5 years. This is the average if you throw out 2014, which was impacted by PEDV. And so next year, we're going to be somewhere 80. We think we're going to top this out somewhere in the low 90s, and then have some pressure on it again in the fourth quarter because of those big numbers. Here's our numbers for the coming year. 29, 30 million. 32 million will be far and away a record for the fourth quarter. 121.9, up 3.2% from last year. Pretty much in agreement with the other two analysts that you see here. We're going to end up the year here at 118.2. That's a record. We ended up getting that one pretty close as it goes. I wish I'd have been as good on prices. But here's our price forecast for the year. And I'm already looking at the first quarter and saying, I was too negative. I mean, we traded net negotiated hogs at $60 and change yesterday. And we've been in that 54 to 55 range already. And that would give you an average probably much better than 54 to 58. You can see where the futures were as of yesterday. We're pretty comfortable with upper 60s, maybe a little into the low 70s here in the summer. The futures 74, 75. The fourth quarter, much better than this year because of not as much slaughter capacity problems, but still big supplies. So we've got it in the upper 50s. October, December futures now averaging 63. This is kind of the same situation you were in a year ago, as at least relative to my forecast. When I was, I can't remember if I was here a year ago or not. I think I was. No, I wasn't. No, 2 years ago. Well, then you missed it last year. Probably did you good. But our forecast for all year, from a fundamental standpoint, had the futures well above it, and we were kind of screaming sell, 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 sell all the way into the spring. And sure enough, the futures pretty well came back to our forecast. I kind of feel the same here. I think the futures are higher than where I can get them fundamentally. They would be trading exceptional demand at these kind of levels. Now, you may get exceptional demand starting in July with the new plants coming on board, but I would be watching these relative to our forecast as we go through the spring. Normally, you take the summer and the fall, they usually peak out in April or May. All right? I would be ready to pull the trigger anytime this hog market, the futures market, shows it's breaking, because I don't think you're going to leave a lot of money on the table on the top side. Now, somebody's going to say, well, what about PEDV? Well, yeah. But how many times is that going to happen? That's in one-off. There's no way I can forecast that. If you pull the trigger and PEDV comes along, yes, you're going to have some very large margin calls. Okay? But I think you need to have a strategy in place to price these hogs sometime in the spring, because we can see big supplies coming in. If there's any glitch develops with trade issues, it could sure be negative. Okay, risk to the forecast. Major export disruption would be the biggest one: foot and mouth disease, African swine fever, classical swine fever, President Trump. All of those are risks to the forecast here. These three have a small probability and a huge impact. This one probably has a much higher probability. We don't know what the impact's going to be yet, though. So I think it's worthy of watching. Diseases. The focus now is on winter. PDV has been pretty good. We've seen a little bit of it. But most folks think we'll probably be in a little better shape than a year ago, but they're still out there, especially in grow finish. Some recent PRRS activity has us a little concerned, always does this time of year. Feed costs this year looks very good. This would have been much better a week ago on pricing 17-18 needs. Before we had this soybean meal run up, but I would still be watching for opportunities. I told you a while ago, 330 and 330. I think there's pretty easy rules of thumb, and especially if you see this bean meal get back into the low threes. Soybean meal through March looks good. Demand growth in 17. Will we have demand growth? Preferences. We've been a real beneficiary of renewed preferences for meat proteins the last few years. If we can get some wage and income growth, it would certainly be helpful on the demand side. And, of course, on the export side, three issues. One of them is what happens with China, Hong Kong. They're still a big market, even though they're not as big as we would like them to be. The other one is Mexico, and the longer-term impact of Mexico and the longer-term concern is what happens when their industry keeps growing. We understand they're putting down about 200,000 sows south of the border. That's an increase of 15, 16%. Those products, the products out of those animals, well, generally the end meats will probably stay in Mexico. The middle meats, they have a free trade agreement with Japan, will likely get exported, the higher value products. If that's the case, they're going to impact our exports on both sides of that. There'll be competition in Japan, and there'll be competition at home for the lower value cuts that we generally ship down there. So this is a concern over the next 3 or 4 years. The U.S. dollar, always a concern on the export side. The impact of competition for hogs in the second half of next year. We originally said $1 to $3. Joe Kearns, friend of mine, many of you know Joe, has always said 5 to 7. We're probably going to increase our impact of that just a bit, just to see what happens. But you have to remember that it's only an enhanced competition for hogs if the number of hogs doesn't grow enough. All right, if the number of hogs comes up pretty close to what's needed, then the impact of that new competition is mitigated pretty sharply. So we think it's going to be some impact. I'm still kind of leaning toward the lower side of that, but would concede that maybe 1 to 3 is a little low. Pork prices, if plants are full in 18. Longer term, my big concern is, if you got 10% more packing capacity and you add close to that many more hogs and you add 1% or 2 to the weight of every one of them over 2 years, how much pork is that? Well, it adds up to 10% plus pretty easy, and that is a really rapid growth rate for domestic consumption. I don't think we can support that. We would have to have very robust exports to get that done. So, this has to be a record, okay? But we got plenty of time for question and answers. If you'd like to ask a few questions, I'll give it a try on the answer part. Don Buell asked me a while ago, he said, am I going to feel better or worse after I listen to you? And I said, well, Don, that largely depends on how you feel now. So, Don, what is it? Kind of fair to middling?
Feeling good.
Feeling good. Okay. That probably means go sell your hogs. Yeah?
How big is Mexico's freezer?
I don't have any idea. Freezer. Probably not very big, would be my guess. I mean, I don't even know that Mexico publishes any kind of cold storage data that I'm aware of. So I wouldn't know that at all. Don?
Mexico should not have the advantages we have as far as producing pork. I mean, their grain supply is fairly limited, right?
Yeah, the question is, long-term, Mexico shouldn't have the advantage we have on pork because their grain supply is fairly limited. That is right. They import a lot of the grain they feed hogs already. Okay, and most of the plants and the location of, even though some of this expansion is down in the Yucatan as well in northwest Mexico, but there's a lot of it in northwest Mexico, that is all pretty well destined for export product. All right, and I don't know kind of the efficiencies of getting that done, but no, they're not very competitive. But they have a free trade agreement with Japan. They have a very weak peso right now, which means that they. Yeah, if you got to buy grain with a weak peso, that's not a good thing either. Yeah.
Can you talk about some of the risks on possible free trade agreement adjustments that might occur?
You mean?
Could the coming administration free trade renegotiations?
Well, it's been interesting, and I think there's a whole lot of uncertainty about that. Okay, but what we do know is the president-elect has said that he wants to renegotiate the NAFTA. Now, the interesting thing is, the Canadians and the Mexicans have said, fine, we'd like to renegotiate it too. Okay? So I don't think the issue of renegotiating NAFTA is really something to be afraid of. I think what we might be afraid of is where we end up after the renegotiation. Because if they're so eager to renegotiate, exactly what are they going to want out of this thing? And one of the real difficult parts, not a lot of you in here probably remember 1992 and 93 when this was going on, was the agriculture sectors of that agreement. It took a long time to hammer them out. So there is some risk there, I think. But we had free trade agreements and we've had very low tariffs on pork products even before that. Now, the NAFTA certainly helped us, took them all the way to zero. So that's one. The whole situation with China is one of those that I'm really ambivalent about. I mean, the president has basically called out China as a currency manipulator. Well, is that news? I mean, we've been seeing this for years, and nobody has stood up and said, no, we're not going to allow you to do that. You have to let your currency float. We'll see if he stands behind that. There's going to be a lot of political pressure not to. I heard the Obama administration's national security advisor saying this morning that, oh, no, you don't want to start messing with China. And I'm kind of thinking, well, there's probably a few things we ought to mess with China on. So we'll see kind of where that goes. That's the number one relationship. TTIP, the free trade agreement with the Europeans, TPP apparently is dead. I don't think it's got the support in the Senate to get ratified. And so if you're going to do that, it's going to be back to the drawing board. TTIP, the agreement with the Europeans, I think was pretty much a long shot anyway, and I'm not sure we would ever have really benefited from it. Again, what good is a free trade agreement with professional protectionists? And so, I'm not quite as negative as some are on it. We'll see what happens. I will say this. I don't think any of it's going to happen this year. I mean, I'm not sure anything's going to happen that's going to disrupt things too much in 2017. We'll see, but these things take a long time to get to hammer through. Now, if we start unilaterally bailing out of things, then all bets are off. But yeah.
Hi, Steve. Mike Rhodes from Advanced Trading here. Quick question with the run-up in the cutout that we've seen and the increased profitability for the packers. Do you have any recommendation or thoughts for producers to try to migrate away from getting paid off west of the Corn Belt or Iowa, southern Minnesota, and try to get a contract payable on a percentage of the cutout?
I think it's a great idea, depending on the percentage.
Right.
If it's 92, that's probably good. If it's 75, I don't think I'd do that. All right? A typical economist answer, that depends. There's several issues in that question. One of them is the daily reported price dependable? All right? Nationally, the negotiated part of hogs that are negotiated every day averaged 2.4% last year of all the hogs every day. That was the average percentage on a daily basis. That's a pretty small number. You can certainly get some mismatches between the amount available on the negotiated and the amount desired on the negotiated. And we saw that price was more volatile. It always has been, and it certainly was running well below the other purchase methods this fall, as we thought it would given this tight supply situation. One of the reasons that producers were so supportive of adding pork to mandatory price supporting on the last reauthorization was to get a more dependable cutout value. Prior to that, the voluntary report on wholesale cuts was even thinner than the negotiated market on hogs. And I would argue very easily manipulated. Now, the good thing is if packers were manipulating, they would want to manipulate it up, and that's good for us. But mandatory price reporting was one of the solutions to that. I think we have a very good cutout value at the present time. Now, it has some warts. We had an adjustment this fall on the ham side that caused some changes. We just had an adjustment, which is going to be annual from now on, is what USDA tells us, of the yields, which caused some changes just a week ago. But if you do that every year instead of every 3 or 4 or 5 years, you're not going to get nearly the kind of impact when you change the yields. And they're doing a survey of packers every year to get those yields, keep them modern, keep them updated. So I think the cutout value is a good alternative, again, depending on what percentage you can do it. I would do it on a percentage basis. I wouldn't do it on a fixed differential because, if you have very high or very low values, percentage tends to share that better than if you have a fixed differential. I think it's a viable alternative. There are some folks out there that have a price that's 50% Western Corn Belt, 50% National Net Negotiated, whatever, and 50% cutout. That captures some of the dynamics of both markets. I would say that that's a reasonable approach to take here. So I think there's a number of things we can do. Now, one of the problems here, though, is that the futures contract settles to the CME lean hog index, which is almost 100% dependent on that negotiated market. It's negotiated plus swine or pork market formula. Now, any hogs that are on a cutout value go in that swine or pork market formula, and would we like to have those separated? Yeah, we would, but then you got these hybrid contracts that you don't know where to put, and so there's some talk about how to handle that. There was a very, very talented group of people who met in Des Moines just a couple weeks ago to talk about this again. I don't see a lot of solution for the negotiated problem. I mean, the more we talk, everyone agrees there needs to be more. Everyone goes home and doesn't do anything different. All right? So until somebody does something different, then that ain't going to change. And there are a couple of solutions. Both are unpalatable. One may be more unpalatable than others for individuals. One of them is to mandate that everybody has to sell X% on negotiated and everybody has to buy X%. You can't do one or the other. It's not fair to say the packers have to buy it if we're not going to make you sell that many. All right, and that's my opinion. The second one is to solve it with a market solution that basically charges people who use the data to formulate their hogs and rewards the people who negotiate to produce the data. That's a cumbersome thing. It would require legislation. It would require a referendum, just like your checkoff. It'd be a checkoff, a marketing checkoff, let's say. But that would solve the tragedy of the commons and the non-market problem here that's caused us to not have hardly any hogs negotiated. So there are some solutions. They're not very palatable, all right? And the other solution, though, if everybody goes, let's say tomorrow everybody goes to the cutout, all right, then we would have no negotiated. You would still have the cutout values going into the swine or pork market formulas. It'd be all pork market formulas. And you'd have a futures market that supposedly is trading the carcass of a pig sold from a producer to a packer being priced based on the value of the product, the carcass coming out of the packer. I have some friends that trade that on the speculative side, and they don't think that people want to speculate on that very much if they're not trading the same thing that what's actually selling. And if you don't have specs, you don't have a market. So this is a can of worms. There's not much question about it. The best solution would be everybody negotiate about 10% of their hogs. Now, like I say, this group has met, a couple times a year, Don, for 10 years, and we've always come up to that solution, and we've asked people to do it, and it's never happened. So I'm not holding my breath. 20 years. Jim. I haven't watched it that close, Jim, to comment on it. I'm sorry. I haven't watched it that close. One of the problems of joining an outfit that has more than one person is I don't have to do everything anymore. One of the negatives is I don't have to do anything anymore. Sorry. And I haven't talked to Eric, who does the grain stuff. I should have talked to him before I walked in here this morning, but didn't have a chance to. Oh, who's going to win the Super Bowl? Now, there's some real predicting there.
Not the Vikings.
Not the Vikings. Okay. Tim's right on top of it again, I'll tell you. Thank you so much for being here. I'll be around for a while if somebody wants to visit privately. It's great to be back to the Minnesota Pork Producers, one of the best meetings that I attend all the time, and it's great to be around really professional hog growers like you have in this state. Thanks.